Silicon Valley Bank's holding company filed for Chapter 11 bankruptcy protection this morning, just 1 week after the FDIC's takeover of the collapsed bank. Joining us with his thoughts on SVB's sudden meltdown and the government's response is William Isaac, former chair of the FDIC. William, thanks for joining us here this morning. First and foremost, if you were to kind of encapsulate everything that's taken place and the response that we've seen thus far, how would you explain this? Just give us your perspective on it.
That's a big question. Let me take a shot at it. We've been a long period of time with not very much fiscal responsibility or monetary responsibility at the federal level, and the federal debt has grown massively from about 5.5 trillion at the end of the Clinton administration to 30 trillion plus today. In addition, we've had a lot of monetary buildup. The Fed's balance sheet has now got $9 trillion of debt. When Paul Volcker was chairman, it never went over 800 billion. So there's been a lot of money pumped into the economy, and we have inflation. And inflation is something we've got to bring to a halt. Jay Powell has been doing that, trying belatedly. The Fed should have been doing it years ago, but he's been putting the brakes on and trying to raise, not trying to raise interest rates, but trying to reduce inflation. And the way you do that is you raise interest rates, and that reduces economic activity and brings prices down over the long haul. That's just essential, and so that was what was going on. Has been going on. Just as Jay Powell was getting ready to do that, Silicon Valley Bank started buying massive amounts of government debt and keeping them on the balance sheet, fixed rate. And that was I guess something that they thought they were hedging, but it was a terrible mistake. It's not the first time that mistake has been made. It was made in 1979 when Paul Volcker was chairman of the Fed and I was at the FDIC. First Pennsylvania, the largest bank in Pennsylvania, and reportedly a good bank, decided to make a heavy bet on investing in U.S. Treasuries. They did, and they lost because Volcker started raising interest rates. The value of those Treasury securities went down. The bank was insolvent, and we had to deal with it. Silicon Valley Bank's actions here were irresponsible. I don't know how they could have made that bet in good faith, but they did, and they lost. And it's really too bad that this has caused all these problems to be stirred up. This is something that has happened before. It's been punished before, and why they had to do it again, I don't know.
Bill, do you think that the cap on uninsured deposits, or the cap on insured deposits, I should say, needs to go up?
I don't think it needs to go up. When I went to the FDIC in 1978, the cap was 40,000. During the S&L and banking crises of the 1980s, which were massive, Congress raised that cap to 100,000. And the FDIC was lukewarm at best about raising that cap, but the Congress did it. And then I think in the 2008-2009 period, it was raised again to 250,000. I don't think it needs to go up. I think that's a lot of money. The FDIC was supposed to protect ordinary depositors,
right?
And it wasn't supposed to protect fat cat investors at Silicon Valley Bank.
Well, I think there was probably a mix of them in there. I just quickly want to squeeze in one more question, but before we run out of time, you did tell Politico that there was no doubt in your mind that there would be more bank collapses. It's been an eventful week. Do you still think that is the case?
Oh, there already has been.
Right.
So
do you think there'll be more from? Do you think there'll be more from here?
Yes, but people need to be calm. The federal government, the Fed, the FDIC, and even the Congress if need be, have a lot of power to deal with things. I hope we don't overdo our concerns. But an example, Silicon Valley Bank and the bank in New York, Signature Bank, that went down, both of them, they were aberrations. They're not normal banks. They were strange banks, investment banks of sorts, and they were not run like ordinary banks. And if you add them up together, they're $300 billion. That sounds like a lot of money, but it really isn't. It's a small percentage of the U.S. economy, which I think is something like the banking system, something like $23 trillion, something like that. And so we really have reacted very strongly, and I think too strongly, to what's going on so far. There could be more failures, and I'm not going to predict there aren't any, but I don't see anything that we can't handle fairly easily in this country. We've got a lot of wealth. What I'm more concerned about is that the federal debt is way out of control, massively out of control, and the monetary policies have been far too liberal, and we need to fix that. Those are serious long-term issues that the U.S. has got to get its hands around.
Bill, got to leave it there. Thanks for your time. Former FDIC Chair Bill Isaac, appreciate your perspective. Thank you.
Thank you.